Stop scrolling. What I'm about to show you is the first domino in a debt crisis I've been warning you about for months, and the financial media is barely covering it. A Gulf state just quietly signaled to Washington that it may need to start selling US Treasuries. Not because it wants to, because it has to. And on the other side of the same week, the new Fed chair nominee floated the idea of dumping the Fed's mortgage backed securities back into the market. Two of the biggest pressure valves in the entire US financial system cracking in the same 7 days. Now, if you think the system is rigged against the average person, stay with me, because what I found is going to confirm everything you suspected. The same debt rules I spent 25 years pulling clients out of, the United States Treasury is breaking every single one of them. And the people running the system know exactly what's about to happen. A few months ago, I told you a liquidity crisis was coming. I walked you through the private credit time bomb. I pulled up the Fed funds rate chart all the way back to 1954, that 30-year climb to the 1981 double top, and the 28-year decline straight into 2009. And I told you we never actually dealt with the 2008 debt crisis. We just pushed it forward. That's exactly what's happening right now. The bill is coming due. And today I'm going to show you the mechanism, what the UAE warning actually means, why Kevin Warsh just hinted the Fed might unwind its MBS holdings, and most importantly, what this means for the debt sitting on your personal balance sheet. Because here's the part nobody on cable news will say out loud. When you can't pay your debts, the bank takes your house. When they can't pay their debts, they print money and you lose your purchasing power. Same default, different victim. Let me explain. Here's the setup. The Strait of Hormuz, that narrow shipping lane in the Persian Gulf, handles roughly a fifth of the world's oil. When energy flows get disrupted there, the Gulf states have a cash problem. Fast. The UAE, Kuwait, Saudi Arabia, they don't keep their reserves in a checking account. They keep them in US Treasuries. Trillions of dollars of US debt. They are some of the largest foreign holders of our paper on the planet. So when energy revenue stops flowing in, they have to raise cash somewhere. And the easiest way to raise cash fast is to sell what you own, which means selling treasuries. The UAE quietly went to Washington this past week and asked about something called a dollar swap line. That's the financial equivalent of saying, we're having a liquidity problem. We need dollars. Help us avoid having to dump treasuries on the open market. Why is that scary? Because if they start selling, and Kuwait follows, and Saudi follows, the price of US Treasury bonds goes down. And when bond prices go down, yields go up. And when yields go up, every single interest rate in the American economy goes up with it. Your mortgage, your car loan, your credit cards, the federal government's own debt service, all of it. And here's the other valve. On the same week the UAE was knocking on Washington's door, Kevin Warsh, the frontrunner to be the next Fed chair, gave a speech where he floated the idea that the Fed should start unwinding its mortgage-backed securities portfolio. Translation? The Fed has been the buyer of last resort, propping up the entire US housing market since 2008. If they sell those MBS holdings back into the market, you're going to find out very quickly what your house is actually worth without the Fed's thumb on the scale. Two pressure valves. 1 week. And I haven't seen a single mainstream financial outlet connect these two stories. So let me show you the mechanism and why this matches the debt crisis I've been warning you about for over a year. I want you to look at this chart. This is the Fed funds rate going back to 1954. And the reason this matters, really matters, is because it tells you the entire 70-year arc of how we got here. In 1954, the Fed funds rate was 1.25%. From there, it climbed for nearly 3 decades. Higher, higher, higher. Peaking in 1981 with that famous Volcker double top at almost 20%. That's the Fed slamming the brakes to kill the inflation of the 1970s. Then look what happens. From 1981 to 2009, that rate falls steadily for 28 straight years, all the way down to zero. That entire downward arc, that's not random. That's the story of an economy that needed cheaper and cheaper money just to keep functioning. And in 2008, we ran out of room. Rates hit zero. There was nowhere left to cut. So we did something we had never done before. We printed trillions of dollars, and we bought up the bad debt. Ben Bernanke, the Fed chair at the time, actually had a phrase for the danger of doing this. He called it moral hazard. Moral hazard means if you bail people out from their bad decisions, they will make worse decisions next time because they know they'll be bailed out again. He warned us about it, and then he did it anyway. $875 billion in TARP bailout spending. Quantitative easing rounds 1, 2, 3, 4. The Fed's balance sheet went from under $1 trillion to over $9 trillion at its peak, almost all of it deployed for one purpose: to save the US housing market and keep credit flowing. Now, here's the part where you need to pay attention. We never actually dealt with the 2008 debt crisis. We just bought time. We took the debt that the private banks couldn't service and we moved it onto the Federal Reserve's balance sheet and the US government's balance sheet. The debt didn't go away. It got bigger, it got slower, and it got harder to fix. I spent 25 years working with people in mortgage finance, and I'll tell you this: every single client I ever helped escape a debt spiral did it the same way. They acknowledged the problem, they built an order of operations, they paid the highest cost debt first, they stopped taking on new debt, and they accepted some short term pain. The United States government has done the opposite every single step. They have not acknowledged the problem. They have no order of operations. They have piled on new debt. And they refuse to accept any short term pain at all. We are now sitting at over $36 trillion in federal debt. The federal deficit is running over $1.8 trillion a year. Interest payments alone on the national debt have now passed defense spending. Let that one land for a second. We are spending more to pay interest on past borrowing than we are to defend the entire country. And this is the part where the UAE warning matters. Because right now, foreign buyers are quietly stepping back from US Treasuries. Domestic buyers can't absorb the supply. The Fed itself is supposed to be shrinking its balance sheet, not growing it. So who's left to buy our debt? At what price? At what yield? This is what bond vigilantes have been waiting on for 40 years. And the mechanism that gets us there isn't a crash. It isn't a panic. It's a slow grind where yields creep up, debt service explodes, and the government is forced to make a choice. There are only two choices when you can't service your debt: you default, or you inflate it away. The United States is not going to default, politically impossible. So they will inflate, which means the dollar in your pocket and the dollar in your savings account buys less every single year, by design. That's why the UAE swap line request is the first domino, because if the Fed approves it, it's a precedent. Kuwait gets one next, then Saudi, then everyone with treasury exposure who wants out without crashing the market. The Fed quietly becomes the dollar lender of last resort to the entire global financial system. And the only way it can fund that role is, you guessed it, printing more dollars. Quick pause. If this is clicking for you, drop a comment and tell me, are you starting to see this in your own finances? Higher rates on your credit cards, your auto loan, your refinance quote? That's not random. That's the mechanism I just walked you through, working its way down from Washington to your kitchen table. And if you want to actually run the numbers on your own debt right now, figure out what's costing you the most and what to attack first, I have free calculators on my website. The inflation impact calculator and the retirement gap calculator are the two I'd start with. Link in the description. Okay, back to it. Here's where the money ends up. Follow the money. That's what we do here. If the United States is going to inflate its way out of this debt, and that is the only mathematically available path, then your dollars are the fuel. Every dollar of new money the Fed creates to absorb Treasury supply, to fund swap lines, to backstop the system, every one of those dollars dilutes the buying power of the dollars you've already earned. This is the part where I have to be honest with you, the same way I was honest with my clients. When I was a mortgage broker and someone came to me drowning in debt, I never told them what they wanted to hear. I told them what was actually happening to their money. Then I told them what to do. So let me do that for you right now. When you take on debt you can't service, here's what happens. The interest compounds. The minimum payments eat your cash flow. Your credit score drops. You can't refinance. And eventually the bank forecloses, repossesses, or sends it to collections. That's painful. But that's a clean default. The debt is settled. You lose the asset. You start over. When the United States takes on debt it can't service, the process is very different. They don't lose anything. They don't get foreclosed on. They don't go to collections. They print. And every time they print, the value of every dollar you've already earned goes down. You didn't take out the loan. You don't get to refinance. But you pay the bill anyway, slowly, through inflation, for the next 20 years. That is the system. That is the rig. That is what people mean when they say the financial system is designed to extract from the bottom and protect the top. It's not a conspiracy theory. It's the mechanism. Now here's the part I want returning viewers to lean in for, because this is where the evidence keeps leading. There is exactly one asset in the modern financial system that cannot be printed, cannot be diluted, cannot be added to, cannot be bailed out, and cannot be confiscated through a balance sheet maneuver at 2 a.m. Bitcoin. And here's the part that always gets me. Bitcoin was created in January 2009, 3 months after the TARP bailout was signed. The Genesis block, the very first block in the Bitcoin blockchain, has a message embedded in it, pulled straight from the headline of the Times of London that day. Chancellor on brink of second bailout for banks. Weird coincidence, right? An entire monetary network was created, anonymously, at the exact moment the world's central banks crossed the line that Ben Bernanke himself called moral hazard. That's not me telling you to buy Bitcoin. That's me showing you where the evidence has led me, and where it keeps leading every time I run the numbers. Because every time the system needs more printing to survive, the asset that can't be printed is going to be repriced higher in those debased dollars. This isn't about price predictions. It's about plumbing. So here's what to watch for. 3 signals. Write these down. 1. The 10-year Treasury yield. This is the single most important number in the global financial system. If it grinds above 5% and stays there, debt service for the federal government becomes catastrophic, and the pressure to print accelerates. 2. Fed dollar swap line drawdowns. The Federal Reserve publishes this data weekly. If you see the UAE swap line approved and then start showing usage, you'll know the dam has broken. Kuwait, Saudi, and others will be right behind. 3. Any concrete movement on Kevin Warsh's mortgage-backed securities proposal. If the Fed announces a timeline to actually sell MBS, the housing market is going to find out what it's worth without a buyer of last resort. And every homeowner in America needs to be ready for that conversation. Those are the macro signals. But I want to be specific about the action too, because watching alone isn't a plan. The system has its order of operations. You need yours. When I worked with debt management clients, the very first thing I did was sit down and run the numbers on every dollar they owed. The rate, the balance, the term, the type. Then we attacked it in a specific order. High interest debt first. Stop the bleeding. Then strategic debt. What's tax advantaged? What's leveraged against an asset? What's pure consumption? I've put every one of those tools on my website. The financial calculators are free. Inflation impact, retirement gap, mortgage and PMI, all of it. Run your numbers. Audit yourself the way I used to audit my clients. And if you want the full picture, the personalized version, where you answer 12 questions and get an AI built report on your retirement readiness, your debt position, your Bitcoin allocation, and your top 3 financial risks. That's the My Financial Picture tool. It's $27. Link in the description. It's the closest thing I can give you to sitting across the desk from me for an hour. Because here's the truth: the macro storm is coming, whether you prepare or not. The only question is whether you walk into it with a plan, or whether you find out what's wrong with your finances the same week the headlines do. Let me bring it home. The first domino in this debt crisis isn't a crash, it's a request. A quiet request from a Gulf state for a dollar lifeline that the Fed is going to have a very hard time saying no to. And once that precedent is set, the entire mechanism I just walked you through starts spinning faster. We never solved 2008, we just bought time. The bill is being delivered now. Through your mortgage rate, your grocery bill, the value of your savings, and the price of every asset that can't be printed. If you want to act on this, actually run your own numbers and build your own debt order of operations. Every tool you need is on my website. The free calculators are linked in the description. So is the My Financial Picture report if you want the full personalized version. Next week, I'm breaking down exactly what happens to the housing market if Warsh follows through on the MBS unwind, and which homeowners get hurt worst, because that one is going to surprise even the people who saw 2008 coming. Subscribe so you don't miss it. Drop a comment with the one piece of debt you'd attack first. I read every one, and I'll see you in the next one.